Welcome to Financial Revelations. I am David Safransky, your sweatered host. I ask a lot of opinions about my clothes. To be honest, I really don't care what anybody thinks. I'm going to wear what I like. And I love this sweater. So I hope you like it too. You can get to us a couple of ways. At SkiBucks1, which is on Twitter, at SkiBucks1. You can call us, 1-800-344-2534. 1-800-344-2534. A lot of people call us. So I love that. Thank you very much for reaching out. And you can hear me every Thursday morning on WCRF 103.3 until they fire me, which will probably be soon, on Thursday mornings at 8 a.m. You could also use their app, the Moody Radio App, to listen anytime from anywhere. For any reason, I guess. And this will all be rolling past me on a scroller that Corey puts up. We got a new background too. I hope you guys like that. I'm excited about it. Big upgrades going on around here. And if you have questions, you can email Corey at corey@epsf.com. Now, a lot of people want to know if they want to work with us, if they want to use our money management services, how do we do that? Where do we start? And it starts with you contacting us, and we send you out a fact finder. And the fact finder is basically paperwork that kind of lays your financial cards on the table so I can review it. I'm still going to call you no matter what it says, even if there's nothing there. You have no money, but you want to get money. You want to be better with money. You want to learn how to budget. We'll do those things. But I don't sit down with people who don't send that back because I don't want to spend our time together gathering facts when I could already have them and have kind of looked at them and gotten an idea of what we're looking to achieve. And so that's why I ask for a fact finder first. And then I have that data in the file. So when we sit down, we can talk about things that are really important to us, which is what you want to see happen. And maybe it's a very concrete goal that you have. I want to retire in 5 years, or I want to send my kid to college. I'm going to recommend that you don't send them to a college where they're going to become leftist, communist liberals, but that's up to you. I want my kid to come out being normal. I think liberalism is a mental illness, so a lot of schools are teaching that right now. And it's a big fight. It really is a big fight on college campuses right now for our youth. And it's important for us. It's incumbent upon us to send them to a place where they're going to learn and not be indoctrinated. I don't want my kid indoctrinated. I want them to learn. And that's, they could come up with their own opinions. That's fine. But I don't want people forcing that on them. And that's what's happening in a lot of higher education today. So today we got a couple of things to talk about, but I'm going to answer some listener questions that we got. It's kind of like this versus that, us, not us versus them, but like which would be better, which would you rather kind of thing. So, but I just want to mention that the Fed still looms really large in the market because the economic data that's come out since February 1st has all been really good. It's been too good. It's been too positive. And I know that sounds strange that we don't really want positive economic data right now, but this is why it's not optimal. It's not optimal because the Fed is active in the market to the upside. They're raising rates. And you want to give them a reason to say, I think we've done enough and we can stop now. And they're just not getting that news. So, and I have to imagine that the Fed had a lot of this data when they only did a 25 basis point rate hike on February 1st. They should have gone 50 basis points. They didn't. I think they're going to have to go 50 basis points at the next meeting. But when unemployment is at 3.5% and they want it at 4.5%, and the unemployment rate dropped, the Fed's going to still be active in it. When you get some of the housing price data that's coming out, the Fed's still going to be active. So you want the data, and I know this is like against what we really want, but it's what we really need. And when I say, I don't want to be insensitive to people, because when the unemployment rate goes up, that means people aren't working. And that means, somebody's out of work. They've lost a job. I don't like to see that. I want to see 3.5% unemployment. Really, in my heart, I want that, because I know that when people are working, they can create a life for their families. They can save money for the future. They can send kids to college. They could do a lot of things that they couldn't do when they weren't working. So low unemployment is really good. We have to have the productivity and all the other things that go along with it. Right now, we're getting inflation from it. So we want the economic data to soften up, but I don't want to be insensitive, because I want to see all people, even if they don't agree with me, I want to see people do well. I don't want to see bad things happen to anybody. So as we get this economic data coming out and it's all really positive, it's just another reason for the Fed to stay active in the market. So that's why we want the economic data to soften a little bit. And I think you're going to see that in the coming months. In fact, I know you're going to see that in the coming months. And I don't have a crystal ball, but I know that's happening because the Fed is going to continue to raise. And that's where they're going to be at. So if you have questions about that, and we're going to talk a little bit more about some of the things, one of the benefits that we're going to get out of the Fed being active in the market in a minute here, because I got that question in the past couple of weeks. So, but if you have more questions, if you have something, just reach out to us. I don't know that I'll always be able to talk to everybody, but I can return an email, and we can reach out and answer questions, and I like to do that for people. So here we go. My first one is, what do I like? What would I rather have, a Roth or a traditional IRA? And this is a pretty common question, because people love the front-end tax deduction on a traditional IRA, but I love the tax-free benefits of a Roth IRA. And knowing what I know about the back end of an IRA, so you've saved your whole life, you've invested wisely, you've put in the max every year, and let's say you got, including a rollover from a 401k, let's say you got $1 million in your traditional IRA. That's a lot of money. And somebody says, well, what's it really worth? And my answer is, I don't really know, because I don't know what tax rates are going to do over the next 25 years while you're retired. And so I can't tell you exactly how much we can get out of this, because the government could really get in the way of this. And when you have a traditional IRA, you're in business partnership with the IRS, and they love you, because every dollar that comes out of your IRA, your traditional, is taxable. So a Roth, on the other hand, when you put money in, you don't get a current tax deduction, but as long as you keep that money in there till you're 59 and a half, and you use it after 59 and a half, you can use it for anything, but that money is coming out tax-free. So you say, well, yeah, but what would come out tax-free, because I didn't get a tax deduction on the front end? All of your growth, everything that money grew to, is going to come out tax-free. And that is so powerful, especially, the younger you are, like me, I like to say I'm 45-ish. The younger you are, the more Roth makes sense, because you have what we call time value of money. So let's say you wanted to get to $1 million in your Roth IRA. Well, if somebody started saving when they were 20 to get to that $1 million at the end, they would actually have to save a lot less of their money than if somebody started when they were 30 or 35 or 40, because that money's been in there growing the whole time, getting compound interest. And we don't have to be expert stock pickers to make money in the market long term. There has never been, I'll say it one more time just in case you didn't catch that, there has never been a 20-year period of time in the market that has lost money. And when I mean a 20-year period of time, I mean from like 1980 to 2000, 1981 to 2001. So you could throw in anything you want. You could throw in 2008, the Great Depression, all those things. 20-year period of time, never been one that lost money in the market. So you don't have to be an expert stock picker. You just have to pick good mutual funds if you want to be passive about it. And that's fine. That is pretty good investing, actually. You could get a Vanguard account and buy 4 or 5 different Vanguard indexes, and you're going to track the market. You're going to do okay. And you're going to do okay on the cheap, because they're inexpensive at Vanguard. Now, a lot of people that we work with, we have different portfolios. So we have taxable portfolios, we have tax-deferred portfolios like Roths, and in taxable portfolios, we want to be a little bit more tax efficient because it does help. So there's a little bit more nuance for us. But if it's just your Roth IRA, I don't have a problem with that. So if I was going to pick one, I would do the Roth, especially if I'm younger. And I would, even if you've been doing regular IRAs your whole life, and you're in your 40s or maybe your early 50s or even your late 50s, I probably would open up a Roth and start doing it, because if you retire when you're 65, odds are you're going to live to be 95. And so you have a long time for that money to build up. So even in your late 50s, I don't think it's too late. I think it's a pretty good option to start socking some money away in. And in the same vein, a Roth 401k versus a traditional 401k, the younger I am, I'm picking the Roth 401k for the exact same benefits. I love the tax benefits. I'm thoroughly convinced that Congress has no idea what they did when they allowed the Roth 401k. And at some point in time, the way our population demographics are going, so the baby boomer generation, which is the largest generation as a percentage of total population ever. There's more baby boomers than any other generation ever as a percentage of population. The last baby boomers are going to retire around 2030. Okay, you think about the generation after them, which is my generation, Gen Xers, is one of the smaller generations. It's going to be tough to pay for the baby boomers. It is. It's not that they're going to just take their money out of the market and everything, but they're not really contributing anymore because they're retired. So they're taking money out now. It's going to be tough to cover those costs: medical care, Medicaid, Medicare, all those things, Social Security. So I think tax rates are going to have to go up. And I wouldn't be surprised to see the government say, well, look, we know we promised no taxes on the Roth, but there's going to be an excise tax if you have over a certain amount. I could see that happening. We live in a punish the rich. We should be rewarding rich people. We should be encouraging people to work hard and strive to make money. That's what free market capitalism is really about. We don't want to punish poor people. We want to help them. We want to help people get educated, stay educated, get skilled. Not everybody has to go to college. That was one of the things about the shale boom that was so exciting, is that you had really good, high-paying, powerful jobs for people that didn't go to college. So you could have a trade like a truck driver or a welder or an oil rig worker. You could make $150,000 doing that. And when the Biden administration came in and kind of put the kibosh on fracking and horizontal drilling, and I know we still have rigs going and everything, but the rig count isn't growing anywhere near what it was. And we gave away some of our national security by relying on oil from people who don't like us. We're still trying to make a deal with Venezuela to get oil from them. They have the dirtiest oil on the planet. There's only a couple of refineries on the East Coast that can refine their oil, and they don't want to do it. It's very, very dirty. So drilling here, working here, putting people to work here in those high-paying jobs, that's our best option for energy security. And energy security is everything. When we control our own energy, we control everything. There's so many things we wouldn't have to do if we were creating our own energy here, and this administration is kind of against that. So that's my spiel on Roth and oil. UTMA, Uniform Transfer to Minors Act versus a 529 plan. So if you're planning for college, it's not even close. I could tell you dozens of Uniform Transfer to Minor Act horror stories where a kid turns 18. There's also Uniform Gift to Minors Act. Under UTMA, you can hold the money till 21. UGMA, it's 18. So at 18, that money is at kids. How many kids are prepared for $100,000 at 18 with no strings attached? You can do anything they want with it. Well, not a lot. Maybe yours is, but it's rare. 18-year-olds are really kind of like the dumbest animal on the planet. And it doesn't matter if you come from a good family or anything. These are kids with no perspective and a lot of money all of a sudden, and they tend to do unpredictable things. So I like a little bit more control. And with a 529, you get it. And you get tax advantages. If that money in a 529 is used for higher education, it doesn't have to be college anymore. It could be trade school. It could be a lot of things. It could go be a welder. They could go to truck driving school. I know I've used those a couple of times, but you would be surprised at how many things you could use your 529 for. You could also use it for secondary school, like private school. I don't recommend that because now with school choice in a lot of states, your tax dollars follow you if you're in a failing district. So I would use that first. But the benefit to a 529 is in the longevity. So the longer you have it in there, the more the benefit is. But I would choose a 529 hands down over a UTMA or a UGMA any day. Any day. It's way better. You have investment choices, and the money is never the kids. It's you control the money. And I love that. And you don't have to give it to them. So let's say that they get out of high school and they don't want to go to college and they don't want to go to trade school. You don't have to do anything with the money. You just let it sit there. You could name another beneficiary to it. So a kid after them, you could change the beneficiary to your spouse. So there's a lot of things that's very flexible in that. Now, true, if you take the money out and don't use it for higher education or anything like that, there's a 10% penalty. But you're going to use it for higher education of some kind because we're living in an age of specialization. You cannot just graduate from high school and expect to get a good job. It's not going to happen. It's unrealistic. So we've got to instill in our kids and our grandkids. I don't have any grandkids, but if I did, you've got to get training of some kind. You cannot just go out there. You're not going to earn an income. So be preparing your kids and your grandkids for higher education of some kind. The last thing, I'm getting a lot of questions on bonds right now. And yes, bonds are back in play in a very, very serious way. I can get 5, as of this day, I could get 5%, over 5% on a 1-year government bond. That is extraordinary. I bought more bonds in the last 4 months, 5 months, than I have in the last 14 years. You just couldn't use a bond for a long time because interest rates were zero. So you'd get 1% on a 5-year government bond. In good conscience, I cannot do that to people, and I will not do that to people. So we found other things to do. And there was a little bit more risk involved, but we got a yield on them. So yes, bonds could be a good way to kind of drag risk out of a portfolio right now and get a good yield. So I'm looking at government bonds. I'm looking at corporate bonds. I like muni bonds in the right place. So muni bonds are good because if it's a muni bond issued in the state that you live in, it's federal income tax free and state income tax free, and it could be local income tax free also in some cases. So it could be triple net free tax. Now, if you buy a muni bond in a state that's other than your own, you're going to get taxed on it state-wise. So, but no federal income tax. If you buy a U.S. government bond, so something from the Treasury, a bill note bond from the government, it is federally income taxable, but not state income tax. So if you live in a high state tax area like Hawaii, New York, California, you could get a nice little benefit out of that. So I like bonds right now, but just like stocks, they have risks. If you sell a bond early, you could lose money. There's risks in investing. If you hold a bond to maturity, especially a U.S. government bond, there is no risk. If you hold it to maturity, it's backed by the full faith and credit of the federal government. Last time I looked, that's still pretty good, and I think it's going to stay that way. It doesn't matter who's in the White House or who isn't. That's going to be okay. We pay our bills. So, yes, bonds are back in play. If you have questions, reach out to us. If you have comments, reach out to us. If you have a comment about my sweater, I don't care. I am David Safransky, a real American, a true patriot, and the voice you can trust.